a real recession where there are massive layoffs, home prices are crashing, stock market is crashing, earnings are going down, that kind of recession. And the LEI is pointing to that kind of recession starting before the end of the year. Hi guys, it's Stock Curry, and the collapse of the US economy just sped up in a major way. Things are so bad right now that even companies who are beating earnings are dropping in share price. New data just came out that you need to know about, so let's get into it. In the UK, Liz Truss just resigned as Prime Minister after her tax plan caused extreme market turmoil. Her resignation after just 6 weeks makes her the shortest serving Prime Minister in British history. Ouch. Here in the US, Federal Reserve's President Harker sees a lack of progress on inflation and expects aggressive rate hikes ahead. Philadelphia President Harker said higher interest rates have done little to keep inflation in check, so more increases will be needed. Given our frankly disappointing lack of progress on curtailing inflation, I expect we will be well above 4% by the end of the year. And it's important to listen to what the Federal Reserve is saying right now because their next meeting is less than 2 weeks away on November 2nd, with their final meeting of the year coming on December 14th. Markets are currently pricing in a 97% chance of a 75 basis point rate hike at the Fed's meeting in November and a 77% chance of another 75 basis point rate hike in December. And as the Federal Reserve continues to raise interest rates in order to fight inflation, the technical recession that we're currently in is starting to turn into a major recession. And the rate at which the recession is getting worse sped up in a major way this week. Existing home sales have now fallen to a 10-year low as mortgage rates have soared. The average 30-year fixed mortgage rate is now at 7.37%. Now, just the other day, I had a baby boomer tell me, hey, Scott, so what if rates are above 7%? I paid that kind of interest rate back in the late 70s, early 80s, and I paid off my mortgage just fine. What's the big deal about rates being above 7%? Well, the big problem is back in the late 70s, early 80s, the average price of a house was around $25,000. Today, the average price of a house is close to $500,000. So a 7% interest rate on a $25,000 house is a really big difference from a 7% interest rate on a $500,000 house. So if you are a boomer and you don't think that these rates are a big deal, please understand we are in the most unaffordable housing market in history because it's not just about the interest rate, it's also about the price of the homes. And as interest rates continue to rise, what this ultimately will do is it's going to cause home prices to go down because there won't be enough people qualifying for mortgages at these really high home prices. So home prices will have to come down in order to get down to a point where people can actually qualify for mortgages and buy these houses. And as home prices come down, well, we all saw what that did in 2008. It's not pretty. And as the collapse of the US economy speeds up, an often overlooked economic measure is signaling serious trouble ahead. The Conference Board's Leading Economic Indicators Index, or LEI, is not usually considered a major data point. But when it's combined with the Fed rate hikes, it's signaling major trouble for the US economy. The US LEI fell again in September, and its persistent downward trajectory in recent months suggests a recession is increasingly likely before the year ends. And you have to understand, the LEI is not talking about a technical recession that we've already been in this entire year. The LEI is talking about a real recession where there are massive layoffs, home prices are crashing, stock market is crashing, earnings are going down, that kind of recession. And the LEI is pointing to that kind of recession starting before the end of the year. Not in 2023 like a lot of people currently expect, but before the end of December. Now, Jeffrey Roach, who's the chief economist for LPL Financial, said, The only bright spot is that financial markets could be close to pricing in all of the damage from both higher interest rates and inflation. Now, if that's true, and I do believe it is, we should get a nice relief rally in November and December. However, we do have to understand that any relief rally we do get might be short-lived because once people realize that the recession is getting worse and it's really starting to affect the economy in a significantly negative way, that could push the stock market back down at a major drop sometime in January, February, March. We're not really sure when, but I do expect a relief rally here in November and December, followed by the market dropping again next year. It's starting to look like this bear market is not going to be a 9-month bear market like we had all hoped. It's starting to be a closer to some of the more major recessions that we've seen in the past, where the bear market lasts 2 or even 3 years. So at this point, it doesn't look like we're going to get out of this until sometime in 2024. Now, the other thing that we do have to watch out for, and this is especially if you're a long-term investor, is that if this turns into be a major recession, kind of like we saw in the 1920s or the 1970s, what often happens in that case is inflation will ebb and flow. So as we get to a point where we are now comping against high inflation from last year, keeping in mind October, the inflation jumped to over 5. And then as we got into January, March, those sort of months, it started rising up 7-8%. So year over year inflation is going to come down, and it's going to look like the inflation is coming down a lot. In fact, I think March's year over year inflation should be around 3.5-4%. And okay, great. We went from 8 to 4, right? Well, not so much, because we're comping against inflation that rose from about 1.5 all the way up to about 5.5%. So it's not actually a true drop in inflation, even though it's going to look like it. Now, as inflation comes down, no doubt politicians are going to call it a victory. The Fed is going to breathe a sigh of relief. They might even start lowering interest rates. Everything is going to look good. That's going to help kickstart the economy going into 2024. Stock market is going to rise. And then very often what happens is we're going to have a whole year of very low inflation in 2023. But in reality, because we're just comping against the prior year, the actual inflation rate could remain quite high, which means as we get into 2024 and everybody's excited and it looks like we're going to go to a new bull market, inflation could end up comping against low inflation in 2023, and we could see the year-over-year inflation start to rise significantly once again, and we could enter another recession going into, say, 2025 as the Fed starts raising interest rates again in 2024. And this is exactly what we saw happen during the 1970s, where multiple periods of the stock market falling as the Fed raised interest rates and inflation was high, and then rising as inflation came down and the Fed lowered interest rates, and then inflation comes back and the market comes down again. And this continued for about 12 years. And it took almost 10 years for the stock market to finally stop falling and to bottom out and start going back up again. So we could be in for a very long cycle of pain in the stock market where we don't get back to new all-time highs for as much as 15 years. And every 2 or 3 years, we keep hitting new lows that are lower than the prior recession. So just be aware of that. Right now, things are getting worse. And it's just a matter of when will they get so bad that the Federal Reserve decides to turn around and start lowering interest rates, start doing some quantitative easing, or at the very least just pause. The problem is, once the Fed does pause, it takes about 6 months for Fed rate hikes to take effect. So very often what you'll see is the Fed will pause and then the recession won't end for about 6 months after that. All of this is coming in 2023. I'm just trying to give you a little bit of a preview. We'll obviously talk more about this as we get a little bit closer. For right now, let's go back to what's happening today, and let's go look at earnings and hopefully the recession information that I just gave you will give you a little bit of understanding as to why companies' stock prices are dropping even after they're beating earnings. Snap plunged more than 25% on a third quarter revenue miss. Snap shares were down over 26% after hours. But here's the crazy thing. Revenue came in at $1.13 billion versus $1.14 billion expected. It wasn't that much of a miss. And earnings were expected to be a slight loss, yet they actually reported an 8-cent profit. So why the heck did Snap fall 25% after earnings when they had a major earnings beat? Well, it all has to do with the forward guidance and the recession getting worse. The average revenue per user was down 11%. And in August, Snap announced that they would lay off 20% of the company's employees. Snap said in a letter to investors, "Our revenue growth continued to decelerate in Q3, and it continues to be impacted by a number of factors, including platform policy changes, macroeconomic headwinds, recession, and increased competition." Now look at this part that I highlighted in green. We are finding that our advertising partners across many industries are decreasing their marketing budgets, especially in the face of operating environmental headwinds, inflation-driven cost pressures, and rising costs of capital. In other words, a recession, high inflation, and high interest rates are all causing advertising budgets to be severely decreased. What other companies generate a large amount of revenue from advertising? Well, one of the biggest ones is Google, with another one being Amazon, and guess what? They're both reporting earnings next week. Snap added that revenue growth is likely to keep decelerating in the fourth quarter. The economic slowdown and potential for recession has also led many advertisers to pause or reduce spending on their campaigns. So that's what's happening on the tech side and advertising side. What about the retail side of the house? Retail is something that Amazon and Apple are both very heavy in. They are the top two largest companies that make up the S&P and the NASDAQ. They both report earnings next week. So it's very important to understand what's happening in the retail space so that we can get a good gauge on how Apple and Amazon might report. And the first company that's a retail company that reports earnings is Whirlpool. So let's take a look at Whirlpool's earnings to see how they did. Whirlpool's third quarter revenue shrank as inflation crimped demand. Whirlpool reported a profit of $143 million or $2.60 per share, down from a profit of $471 million or $7.51 a share in the year ago period. That's a 65% decline in earnings over the past year, with most of that coming in the last quarter as the recession has gotten worse. Net sales also declined to $4.78 billion from $5.49 billion. And the company said it reduced production volumes by 35% in Q3 based upon expectations of softer demand in Q4. Chief Executive Mark Bitzer said, "We see these challenges persisting into the first half of 2023. In other words, Whirlpool sees a very difficult time for retail sales going all the way through the first half of 2023, or another 4 quarters of earnings. Whirlpool stock was down over 4% after hours after already falling over 4% during the day. Now, as the reality of this recession getting worse starts to set in, it's important to understand that stock portfolios are going to struggle for a long time. We might get a relief rally in November and December. Just don't be fooled by it, and don't think that we're going into a new bear market because everything is priced in. As the recession continues to get worse, we will see another leg down that will most likely be lower than where we are currently at in the markets. I hope this information was helpful for you. If you got a lot out of it, be a good friend and share this video with your friends and family. And help me out and hit the like button and subscribe. And if you want more market news and you want to understand what happened with Tesla earnings, make sure you watch the last video that I uploaded here.